Hi, and welcome back to Hedge Fund Manager and this deep dive into super microcomputer. We have now arrived at the fundamental stage, and I have a tip for you this time, and it's to try out my ChatGPT model based on the investing course. I use this prompt for making the model create a full-on run-through exactly in line with the things that we have been doing in these deep dives. So what I said to it is make an analysis of the stock supermicrocomputer, present your forecast for sales and EPS for 4 years and how you arrived at them. Make forecasts for price sales and price earnings based on their historical patterns. This is exactly what you should do. Present your best guess of the stock price for 4 years from now and how you arrived at that conclusion. Also, provide data on what the total annual return is thus likely to be. And you simply go to your ChatGPT, and I have a link for you where you could just try out TIC Sprezza. And here we are at the TIC Sprezza, and in it you can just enter this prompt for any stock you like. And this is what you'll get out of it. And again, I want to emphasize that you will not get any better results than the data you put in. And of course, my ChatGPT model will just give you kind of a watered down version of an actual deep dive. But what you will get is the framework. You will get it ready to use and ready to change and fine-tune according to your assessment of the company. But let's take a look at what we actually get here from Supermicrocomputer and see if we can do better than that. So we get a one-sentence description of what they actually do. It builds AI-optimized server and storage systems. So no wonder it's been the last 5 years winner. They are the picks and shovels of the AI era. Amazon, Microsoft, Meta, all of these companies, they need to build enormous parks of servers and storage systems, and these need to be as optimized as can be for AI purposes. And that means that if you want to be ahead of the game, then you need more or less to go to Supermicrocomputer to buy their stuff. That's the fastest and easiest way, and pay a lot. If you can pay premium to make sure you get the best things first, then you will also be ahead in the AI race. Their key tailwind, of course, demand explosion for servers. And then we have what you get here from free from my ChatGPT model is their revenue guidance. So they have a revenue guidance. And please note here that they recently lowered their guidance. That might be a little bit of a negative fundamental signal, but we'll take a look at the actual growth numbers as well soon. And then we also get the basic fundamentals here in terms of trailing earnings per share, trailing price sales, and trailing price earnings. Trailing means based on last 12 months accounting data. So this is the forecast framework. We have here the growth in revenue, annual growth in revenue, which it estimates. It automatically assumes that the company will slow down to something more similar to its average growth rate, or maybe to the economy if that's more relevant. And you can see here that the growth rate assumed is coming down from 31% to 21% to 17% to 15%. This is more or less a trajectory, a growth trajectory that you would assume if you expected the typical technology S-curve market maturation growth rate to growth or sales to level off pretty soon. I would expect that these numbers are too conservative. There's no way that the AI race is dropping off this quickly. Also remember, this is the revenue in dollar terms, not in volume terms. I would probably adjust these up and say this might actually be the volume terms. And then I would add on inflation on top of this. So I think this is too conservative. The earnings per share growth, yeah, well, they use slightly higher numbers here. I think there is too little operational leverage involved here. I think that if the AI race keeps going on, then EPS growth is likely to be higher. And I also think that the reason that the stock has been the best performer over the last 5 years is that the market is rightly assuming that they will grow profits faster than that. And then we have the valuation forecast. I think it's more to the point here, actually, my model. It's currently at 1.38 times price sales, and they expect it to fall to about 1 in 2029. I think 1 times price sales for a growth company, a leader in its industry, a company that is likely to make at least 10% margins on their stuff. I think this is way too small a price sales number. I'm actually surprised to see it at 1.31, if 38. Is it really that low? Do they really have that low margins? And the price earnings forecast is expected to come down from 62 all the way to 24. Well, I think 24 is probably a reasonable guess for 2029. It gives us a bit of a margin of safety, I think. I mean, if they were to perform with the type of growth numbers we have talked about all the way up to 2029 and even a little bit higher, and then they would most likely be awarded a higher than just a 24 times price earnings forecast. So this is what we've got here in the model is a pretty conservative, value-oriented investor type of analysis. Well, not too surprising considering it's based on my material. We've seen here that historically Supermicro Computer has traded between 0.5 and 1.5 times price sales and just 18 to 30 times price earnings in normalized years. And that's why it's the model is assuming so conservatively. But that is probably because Supermicro Computer used to be kind of just an ordinary hardware manufacturer with no specific edge, but now they are in this niche of AI servers, and I think they will keep being a leader in this space for the foreseeable future. And then we have the price target forecast. Well, it's just a simple P equals F times V over the various years. I think a nice addition here to this deep dive is that they do the P equals F times V for every year. And I think that's a good way to see the likely price progression, comparing year for year exactly how the model would predict the price. And you can see that it has actually a kind of a U-shaped form here with the highest at the end and the beginning and a kind of a U-shape in the middle. What we get here in the end as a total return estimate, well, it's 848 versus 870 today, so it's flat to slightly down over 4 years, so that's a really poor investment prospect. And then the model, a little bit surprisingly, adds not a dividend, but an accumulated annual profit compensation here, as if they were going to pay a dividend. It's both right and wrong, but it's also, like, I mean, they are not paying a dividend now, but they probably could afford paying a dividend. And if they don't, well, they would accumulate cash. So it's probably correct anyway, but it's enough to at least point the finger to that you have to know what you're estimating here. In any way, even adding that supposed dividend, you only get to like 1.5% annualized return. So that's way too little to be a good investment fundamentally.